So, welcome to today's presentation. My name is Peter Joseph, Senior Market Analyst at IronFX. Today we will be mixing once again technicals with fundamentals. In front of your screens you have the US dollar index. It's the 4-hour chart. Mind you that, give me a sec. Mind you that the US dollar got some mixed signals practically on Friday as we had the release of the US employment report for August. On the one hand, definitely the NFP figure tended to disappoint a little bit the markets. Also, the rise of the US unemployment rate tended to be a little bit alarming. But the greenback was able to more or less find its footing in the following hour and be actually able to rise Give me a sec. And that was the main, or if you prefer, the key takeaway of the release on Friday. Now, I would be highlighting here that we had a non-farm payrolls figure which, okay, it edged higher than expected. But we had a revision of the past month's number to the downside. Once again, I think the disappointing part would be the unemployment rate, which rose to 3.8%, implying that the tightness of the US employment market has started to ease somewhat. On the other hand, the average weekly earnings, more or less, I would say that, okay, there was a tick down from 4.4 to 4.3% year on year, but it's not much. It tended more or less to imply that the US employment market is going to be continuing to feed inflationary pressures within the US economy. The release as such tended to enhance market ideas of a possible easing of the Fed's hawkish stance. It was characteristic that a number of, I wouldn't say influencers, but definitely a number of hedge funds in the US have started to warn that the Fed may have reached its terminal rate already, and no more rate hikes are to be expected. That remains to be seen. I would also be noting here on the fundamental side that we have a public holiday in the US. It's Labor Day. And that may more or less bring about market conditions which are going to be relatively light. So there may be thin trading conditions, especially in the American session, given that we have a public holiday both for the US as well as for Canada. So should there be any unexpected moves, don't be so much surprised. That would be a result of exactly this. On a technical level, we see that the US dollar was on the rise on Friday, yet overall remained in a sideways motion between the R100 and 435 and the S100 2.95 of the US dollar index. So we tend to maintain our bias for the sideways motion to continue. Interestingly enough, the RSI indicator remains above the reading of 50. It's actually a little bit closer to the reading of 70 or in the mids. So there may be some bullish sentiment which could provide some support for the USD. Now, should the bulls clearly take over, I would expect the price action to break above the 104.35. You can see how that level was tested once, twice here, aimed for on Friday. A break above the R1 would be allowing practically the pair to actually start aiming for the R200 and 545. At this point, it would be interesting to note that a possible rise of the US dollar index would allow us to actually start drawing also a nice upward trend line, showing us exactly the limitations of a possible upward movement, something like this. Some may even, sorry, give me a sec. 35. A little bit lower, shifting it a little bit to the right. But once again, that remains to be seen. Now, should the pair stabilize, I would expect the index to drop, breaking the upward channel we have just shown, signaling a continuance of the sideways motion, especially if the index practically respects the S1. For a bearish outlook, I would require the pair to drop, break the upward trend line, break also the S1, 102.95, and start aiming for the S2, 101.90, more or less highlighting any possible, let's say, bearish tendencies on behalf of the pair. For the time being, that scenario remains a little bit far-fetched, but it's still a possibility, and it should be covered. Once again, for the time being, given that the price action remains between the R1 and the S1, we tend to maintain a bias for a sideways motion to continue. Once again, though, also bullish tendencies could emerge. It should not be underestimated. Let's have a look at Euro USD, and let's clear the chart. There you go. And this. Let's readjust it. Definitely we see a clear break, interruption of the upward movement, downward motion. The first support line has been broken and has now even started to act as a resistance line. But note how the pair was able to respect the new R1 and the new S1. But before we move on to discuss and comment on the technical side, let's correct the chart. And let's go hunting for a new ultimate support line. Unlocking the chart, moving backwards. This is too narrow. Let's go further back. This is a nice one. It's a little bit wide, I know it, but it has a double touch. Seems to be quite valid. A triple touch. Okay. I'm keeping this one in green. That would be the 1.0525. Working it in, readjusting the chart. In red. Okay, let's correct also the labels. Starting with the R3, which is now being placed at 1.1035. R2 at 1.0945. R1 1.0870. S1 1.0765. S2 at 1.067. And last but not least, the S3, 1.0525. Plugging everything in. Now, let's talk direction. First of all, let's delete this. Sideways motion seems to be maintained, especially given that the S1 was beautifully respected. It held its ground against any downward pressure. On the other hand, we can see that the first resistance line also held its ground against an upward pressure on Friday. So we tend to maintain a bias for the sideways motion to continue between the R1 and the S1. On the other hand, we note that we see an RSI indicator which tends to remain below the reading of 50. It's actually in the midst between 50 and 30. It should be right now at 40 exactly, implying some slight bearish tendencies on behalf of the market. A bearish outlook would imply practically that the pair has to have a lower trough than this one, and that would allow us to draw a downward trend line, something like this. And hence it has to break below the S1 1.0765 and start aiming for the S2 1.0670. A possible move below the S1 would lead us to switch our bias for sideways motion in favor of a bearish outlook. On the other hand, should the pair actually remain in a sideways motion between the R1 and the S1, we would expect it to break the downward trend line we have just drawn and exactly signal that any downward motion has been interrupted. On the flip side, a bullish outlook would mean that we would require the pair to break. Give me a sec, just to adjust it. Yep. We would require the pair to break the downward trend line once again, but that time for bullish outlook, I would require also higher peak than this one. And the price action would have to break the R1 1.870 and start aiming for the R2 1.0945. Note how beautifully it was tested here, here, and to the downside here as well, and here. So it's a pretty valid level. I would be noting on a fundamental level that, okay, we have today's financial releases regarding the Eurozone, but my focus would be on ECB President Lagarde. She will be speaking today. Now, should the ECB President sound more hawkish, given also the slight acceleration of Eurozone's HICP rates in a preliminary level for August, that would allow us to see the euro strengthening and the pair euro USD being on the rise. On the other hand, should the ECB president sound a little bit more balanced, possibly expressing some hesitation on behalf of the bank, we may see the euro weakening and breaking below the S1 1.0765. Now, the euro is a little bit worrisome in the sense that also Eurozone's economic outlook is not exactly at its finest. It's more or less quite worrying. And given the ECB's intentions to keep rates higher or even higher for a prolonged period of time, that could weigh on economic activity substantially in the coming months. Let's have a look at cable. Should be not much of a difference, but yep, it's already up. So there is a difference. It's the 4-hour chart. Let's zoom in. Let's clear the chart. Let's replace the labels. Definitely this has to be turned into support or resistance line, given that the price action has turned lower. Let's go hunting for a new ultimate support level. At this point, I would be noting that we may be having a mid level here, which would be interesting. Let's have a look at that. Somewhere here. You can see how this level has been tested to the downside and to the upside. I think I'm going to be keeping that. In green. Could be widened a little bit. Let's recalibrate the pound. And we have another one a little bit lower. Beautiful tests here and here. Okay, we're setting the charge pretty much wider. Let's reset it. Starting with the R3, which is now being placed at 1.30. The R2, 1.2815. The R1, given that it has been broken, has been turned now from a support line to a resistance line. 1.2675. The S1, 2540. The S2, 2355. And the S3, at 1.22. We have widened the spectrum considerably, exactly trying to reflect the higher volatility of the pair. Yet overall the direction tends to remain in a sideways motion. And we set as an upper boundary the 1.2675, a level which provided support a number of times in the past. And now has been broken and is now considered to be a new resistance line. To the downside, we set as a low boundary the S1, 1.2540. The RSI indicator is nearing the reading of 50 from the downside, implying that the bearish sentiment is practically fading away slowly but steadily, and a more indecisive market is taking its place, which could allow the sideways motion to be maintained. Should the bulls take over, I would expect the price action to clearly move above the 1.2675, and I wouldn't be surprised to see it start aiming, if not even testing, the 1.2815. On the other hand, should the bears take over, we may see the price action dropping, breaking the S1 1.2540, and start aiming for the 1.2355. On a fundamental level, once again, we extend our worries about the UK economic outlook. I would be noting that things may become harder for the UK economy, especially given that BOE seems to be maintaining its hawkish stance in order to curb inflationary pressures within the UK economy. And a continuance of the bank's hawkishness, possible more rate hikes, would, I wouldn't say raise, but definitely would weaken economic activity in the UK economy, especially for the manufacturing sector. Mind you that UK's economy main sector is not manufacturing, it's actually services. So that's going to be a little bit of an issue. Overall, we expect very, very few, if any, high impact financial releases from the UK this week. So we may see fundamentals leading the way for pound traders. And it remains to be seen exactly how the pound will be behaving. I would like to see the European opening of tomorrow, actually, to get a clearer view, given that also the US holiday will be over. Let's move now to USD JPY. Zooming in. Let's clear the chart. Let's reposition the labels. Now, USD JPY has maintained a clear sideways motion, maybe with a forwards break here. But overall, the main body of the price action tends to remain between the R1 146.60 and the S1 144.60. Practically, we're talking about a 200 pips distance within which the price action is roaming. We expect the sideways motion to be maintained. It's characteristic that the RSI indicator has risen above the reading of 50, but remained close by. So more or less, the build-up of bullish sentiment is not exactly there yet. Should the bulls take control, I would expect the price action of USD JPY breaking the 146.60 and start aiming for the 149.40. It's the next possible stop for the bulls, in our opinion. On the other hand, should the bears take over, we may see the price action dropping, breaking the S1 144.60. We definitely need for a bearish outlook a lower trough than these two, which have tested the S1. So practically the price action for a bearish outlook has to go all the distance lower than the S1 and start aiming for the S2 142.25. Nothing less. Once again, our base scenario here is for the sideways motion to continue. Let's not underestimate, though, the possibility of a bullish outlook. On a fundamental level, okay, we have some interesting financial releases this week from Japan. And at that point, I would be noting the release of practically the Japanese GDP rate. And that would be the revised rate, sorry. That would be for quarter 2. Currently, the rate is expected to more or less slow down. Give me a sec. Yep. Sorry, it's expected to accelerate, both on a year-on-year as well as on a quarter-on-quarter level. Should that be the case, we may see JPY getting some support here. For the time being, up until Friday's Asian session, I would be highlighting BOJ. And I would be highlighting BOJ because exactly the possibility of an ease regarding BOJ's monetary policy settings, continuance of its ease, could be a little bit detrimental for JPY's direction. It could weigh on JPY, allowing USD JPY to rise further. And I'm highlighting here that during tomorrow's Asian session, we may have some statements from BOJ officials which could, I think it's going to be BOJ board member Takara, which, should he sound dovish once again, we may see JPY weakening. And to a second base, I would be noting also the rise of the household spending, which would be giving us a better view regarding the demand side of the Japanese economy. But overall, do not expect much movement from JPY regarding financial releases. Try to concentrate practically on 2 elements. The first would be BOJ's monetary policy settings, and the second would be any safe haven inflows, outflows for the Japanese currency. The second nature of JPY, besides being a national currency, also as a safe haven instrument, I think would be the main elements which will be deciding JPY's direction in the next week or so. Once again, though, the GDP rate could be of substantial interest. Let's have a look at USD CHF. Let's clear the chart. Zooming in, readjusting it. Let's reposition the labels. Now, the pair as such seems to be showing some bullish tendencies here. And let me highlight what I mean here. You can see it like this. But for bullish outlook, I would require the pair to rise, break the R1 0.8850, clearly, not like here, here, and here, and start aiming for the R2 0.8915. Otherwise, we may see the price action maintaining a sideways motion. At this point, I think it's quite obvious that we have to recalibrate the R1. At 0.8865. We haven't visited this for a long period. Let's have a look also at the R2. No, there's a clear one. No, we're maintaining that. Okay, so once again, we tend to maintain a bias for the sideways motion to continue. Supporting that idea is practically the RSI indicator, which remains close to a reading of 50, implying a rather indecisive market, yet remains just above it. So there may be a buildup of bullish tendencies. Should that be the case, and for a bullish outlook, I would require a higher peak than this one. So the price action has to break the 0.8865 and start clearly aiming for the R2, if not even tested, the 0.8915. That would allow practically the upward trend line to remain intact, while a sideways motion would be breaking the upward trend line, exactly signaling the interruption of the upward motion of the pair. At this point, it would be interesting to note that we had also the GDP rate of Switzerland, which came out for Q2, and there was a slowdown expected. It was reaffirmed on a year-on-year level, and on a quote-unquote level, it was even a little bit deeper as it reached stagnation levels, 0%. There was no growth in Q2. And that was a little bit worrisome. And let's have a look at what if there was any market reaction at the time of the release. Drilling to the 1-minute chart. Let's go back to the time of the release. No. Here it is. There was no major reaction. Okay. That allowed the pair to remain in sideways motion. You can see it more clearly here. Let's go back to the 4-hour chart. We're adjusting it. Beautiful. So once again, sideways motion being maintained, given also that Switzerland's GDP rate slowdown remained intact. Moving now to the Aussie. We're adjusting the chart, zooming in a little bit. That's better. Let's replace, or if you reposition the labels. Now, a sideways motion is to be maintained, given also the RSI indicator, which is running along the reading of 50, more or less implying that the market remains rather indecisive, but there is a clear indication that the R1 has to be placed a little bit higher, given that we had a double peak here once, twice. And that would be the 0.6515. That's better. So we tend to maintain a bias for the sideways motion to be maintained a bullish outlook. For bullish outlook, we would require a higher peak than these ones. So the pair has to rise, break the R1 0.6515, and aim, if not test, 0.6610. For bearish outlook, I would like to see it breaking below these truths. So it has to break the S1 0.6380 support line and start aiming for the S2 0.6285. It's going to be a very, very, very interesting week for Aussie traders. And I'm highlighting because tomorrow we have RBA's interest rate decision. Now the bank is widely expected to remain on hold at 4.10%. It's characteristic that AUD/ORS imply probability of around almost 99% for such a scenario to materialize, while also the market expects that the bank has reached its terminal rate at 4.1 and is going to be keeping that all the way up until September next year. There was one point of worry, though. There was a catch, if you prefer. And the catch would be that we had Michelle Bullock, which is currently the deputy governor of RBA, and she will be the one replacing incumbent governor Philip Lowe. Now, she stated, I think that was a week ago or on last Tuesday, that the rates may need to be risen even further, may need to be raised even further. However, that's not so certain, and the bank will be keeping a close eye on data. The comment as such, the content of the comment was more tilting towards the hawkish side. Should the bank actually proceed with a rate hike in tomorrow's meeting, that would take the markets by surprise and could provide some substantial support for the Aussie. Maybe even reaching it as high as the R3, 0.6730, if not even higher. On the other hand, though, such a scenario is a little bit far-fetched currently. Another scenario which could take place would be practically for the bank to remain on hold at 4.10%, but the accompanying statement of Governor Philip Lowe to actually maintain a more hawkish stance, which could be preparing the markets or allowing for the door to remain open for another rate hike to come. Such a scenario could also provide some support for the Aussie. On the other hand, should the bank remain on hold at 4.10% and actually the governor delivers accompanying statement which highlights that the bank has reached more or less its terminal rate or implies such a scenario, that could reinforce market expectations and practically weaken the Aussie. But it's not only RBA's interest rate decision this week. We have a number of financial releases, and I would be also highlighting from Australia the release of the GDP rate, which is for Q2 and is due out on Wednesday. Now, the GDP rate is expected to slow down and could weaken the Aussie somewhat. And let's not forget that we have also the building approvals as well as the trade balance figure for July due out on Thursday. Also, I would be highlighting here the Chinese trade data. They are for August. Especially Aussie traders will be focusing on the imports growth rate of China. Should there be an improvement of the imports growth rate, that could provide some slight support for the Aussie, as it would imply practically more exports of raw materials from Australia to China. It's going to be a very interesting week for Aussie traders. Okay, let's have a look at the Canadian dollar. Now, CAD has been in a sideways motion. Give me a sec. Let's zoom it in a little bit. Let's also delete what is not necessary here. And at this point, allow me to reposition or recalibrate a little bit the levels. Definitely the R1 here is out of the picture. We're talking about a volatility which allows the pair to roam between the R2 and the S1. So this level gets out. And at this point, it would be interesting to replace it and find a new resistance line, either in the mids or above the R3. The R1 is clear. The R2 is clear. And ladies and gents, we have a new R3. At 1.3975, it's pretty high. Let's recalibrate also the support lines. In order to better reflect the high volatility here. Let's replace the labels. Now, for the Canadian dollar, it's going to be an interesting week as well. I would be highlighting here Canada's employment data on Friday, which more or less may provide some support for the Canadian dollar should it show that the Canadian employment market remains rather tight. On the other hand, though, I would be also focusing on oil prices. Oil prices have been on the rise. They were able to break above the psychological the psychological barrier of, give me a sec, $87 per barrel. At least we're talking about WTI. And that may provide some additional support for the loonie, given that Canada's economy is a major oil producing economy. Let's have a look at the S2. That has been recalibrated, 20. And the S3. $1.3145. On a technical level, I would be highlighting the sideways motion, practically bound by the S1 1.3485 to the downside and the 1.3645 to the upside. Our base scenario here is that the sideways motion most probably will be continued. On the other hand, the RSI indicator remains slightly above the reading of 50. It's actually at 60, which may imply that there may be a buildup of bullish sentiment. In case the bulls take over, we may see the price action of USD CAD rising, breaking above the R1, 1.3645. A break above it would be necessary for a bullish outlook. and start aiming for the 1.38 resistance line. For a bearish outlook, I would expect the price action to drop, break the S1 1.3485, and start aiming for the 1.3320. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So, disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of this material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. So before we get into Elliott wave theory, I just wanted to do a quick recap on Fibonacci, because you can't really get into Elliott wave theory without actually fully grasping your Fibonacci concepts. So because it's been a while since we've done our Fibonacci series, I thought we would spend a couple of slides to talk a bit about our Fibonacci techniques. Then we'll get into Elliott wave theory, look at the different types of waves, and a few shapes. So there are a lot of different shapes, about 50 plus if I'm not wrong, but I'm just going to be going through 3 or 4 in this session. Okay, let's get started with our Fibonacci now. So these are the Fibonacci numbers that we typically use. So if you've been with us before, you would know that we use 4 different types of Fibonacci. We use the Fibonacci retracement, which is the numbers that's in between, so 23.6 to 78.6. And then we have the Fibonacci extension, which is the 127 to 161.8. And then we have Fibonacci expansion, which is the negative 61.8 and negative 27.2. Okay, in this GIF that I've included here, we are just showing you the Fibonacci retracement, which is the most basic form of Fibonacci. Okay, I'm not sure why my projections GIF isn't showing up, but I will go into depth what exactly projections are in the later slides. So firstly, we can look at the retracements that I went through earlier. I mentioned earlier, only consists of a starting point and an ending point. So you can see the point 1, point 2. What's important to note about this is basically just to follow the shape of the chart. So you can see it's pretty clear shape, clear cut shape, and actually for all of the Fibonacci, we highly stress on following the shape of the charts. Next, let's take a look at expansions. So expansions are the negatives of the range of Fibonacci numbers that we use. So if we take a look at the expansions GIF here, you can see we have 3 points that we take note of, one starting point and then an ending point. So for expansions and extensions, these both use the Fibonacci retracements tool on TradingView and on MT4 as well. Only the projections one that requires 3 points, then we use the Fibonacci extension tool. So it's a bit confusing at the start, but basically these three, we use the same tool, the Fibonacci retracement tool. So we have a starting point here and an ending point. And our third point is just to make sure that we retrace at least 50% of the chart. So typically expansions and projections are used together, and we want to look for a flash kind of shape. So you can see here in the chart, we have this lightning bolt kind of shape, or some people call it like a Harry Potter kind of shape. So that's what you want to look out for when you're using expansions as well as projections. But I'll give you a couple of examples later on. Next, if we take a look at extensions, this is what we call the Nike tick Fibonacci method. So we have a starting point and an ending point, which is the head of the tick. And then it has to retrace at least 100% of the head of the tick to be considered a tick. Obviously, the tail has to be longer than the head. So this is what we're looking for. Extensions, we use the more than 100% values of the Fibonacci range. Okay, let's take a look at a couple of examples in the charts so that it's a bit clearer. So here, we have all of the 3 ranges for you to take note of. So from 0 to 100% is the range of Fibonacci retracements. Then we have the positive Fibonacci retracements, more than 100%. Not included here is the 161.8 as well. So it's important to take note of that if you are using the Nike tick. Next, if you see me looking to this side more, it's because my monitor is on this side. So yeah. And then on the other hand, with the negatives, is our Fibonacci expansions rather. And this is the negative 27.2 and the negative 61.8. So let's start off by looking at the Fibonacci retracement method. So we have the starting point over here and the ending point here. And as you can see, I'm looking at where price has retraced, hence the name Fibonacci retracement. So over here, I've highlighted this area in which price has bounced off of. And this is the 61.8 area. So we take note of this level because price has reacted off of this specific level. So that's an important level for us to take note of. So what we like to do is once we've identified a specific level, because it can get quite messy if you're looking for Fibonacci confluence in which all of the different Fibonacci's line up in the same area. So what we do is once we've identified an important area, we just get rid of the other levels and just solely take a look at this one highlighted number. Here's another example of a Fibonacci retracement. So I have our starting point here, ending point here. My 38.2 is at this overlap support level at the 32544.21 level. So it's an overlap support because we have a swing high. We have a swing high that has that's at the same level as a swing low. So it's basically where the bulls and the bears respect a specific area. So at this overlap support, we also have the 38.2% Fibonacci retracement that lines up with that area. That's why I've highlighted it here. Okay, another example here. So here I have two levels that I've highlighted to show you guys briefly how we use Fibonacci retracements to support our resistance and support levels. Okay, so firstly, let's take a look at this 61.8 that lines up with my resistance at the 0.92637 level. So at this level, it's obviously a swing high resistance with the swing high highlighted here. And then using our Fibonacci retracement, I've noticed my 61.8 lines up with this level and price has reacted off of it nicely, which is why I've just kept that level. And then I pull out another Fibonacci retracement from this swing low to this swing high here in order to find a retracement level that lines up nicely with my swing low support. So this is a multiple swing low support with 1, 2 swing lows lining up nicely. This is at the 0.91614 level. Okay, so and then once again I can see that my 61.8% lines up nicely with that same level, which is why I've highlighted this area here. Okay, so I hope that's been pretty clear on Fibonacci retracements. Pretty straightforward method to use. So, but let me know if you guys have any questions throughout the webinar. Okay, if there are no questions, we can move on to our next Fibonacci recap. Okay. Okay, so the time frame, we typically will analyze on either the 1 hour or 4 hour time frame because the shorter time frames, like the 5 minute, 15-minute time frame, those tend to be a little bit more noisy. So we stick to the middle for 4 hours or 1 hour, depending on how clear the charts are. But it really depends on your own trading strategy. So if you are a swing trader, you might prefer a longer time frame. If you're scalping, you might prefer a shorter time frame. So it really depends on you, but we just stick to the middle whenever we are analyzing. Okay, so next, let's take a look at Fibonacci expansion. So once again, expansion, we are looking for a flash symbol or lightning bolt symbol. So you can see here, in the example I've included, we have a starting point over here at point 1, and then at point 2, we have the ending point. Point 3 is where we then start to analyze whether price has retraced at least 50% in order to form that flash or zigzag shape. So in this example, price has retraced up to the 61.8% level. So that's how I know it's more than 50%, definitely more than 50%. So I can use it to predict or to forecast where price is going to come down to. So I can see here, at my last arrow, I'm expecting price to come down to this negative 27.2% level. And I'm expecting price to bounce off from this level. And we've included support because it could be a possible support level. Okay, so for Fibonacci expansions, we are looking at the negatives, mainly negative 27.2 and negative 61.8. Okay, and then we can see the outcome of what we have analyzed in the previous slide. At the negative 27.2 support level, price really did bounce up nicely off of the Fibonacci retracement. Okay, and then a pro tip that we have included here is that price usually does come back to its ending point, which, as you see in the beginning, at point number 2, that's where our ending point is at. Okay. Next, we're looking at over here we're looking at the Fibonacci extension. So like I said, this is a really quick, just kind of recap before we dive into Elliott wave theory. But I just thought that in order to really understand Elliott wave theory, you really need to have your Fibonacci techniques in check. So it's been a while since we've done our Fibonacci series, so we're just going to do a quick recap here. But if you have any questions, feel free to let me know. Okay, so next we're moving on to our Nike tick or Fibonacci extension. So the extensions we're looking at are the 127.8, I think, and the 161.8. Okay. Um, Here you can see very clearly that we have an upright Nike tick. You can see exactly the shape of the tick, but it can also possibly be upside down. I think I have examples later on to show you guys an inverted Nike tick, but it's basically the opposite of this, but upside down. So it's like the head here and then the tail is longer. So starting point here, ending point here, we always want to make sure that we're looking for this V shape. And an important point as well is that you want to make sure that it retraces fully the 100% here. So it has to fully retrace it and go beyond the 100% starting point. So you can see over here in this example, it has retraced more than 100% and it has moved up to this projected level at the 161.8% level. Okay, so it's at this 161.8% projected level that we are expecting a reversal off of this level. And you can see that's exactly what it did. So not included here is the 127% level, which would be somewhere over here. So once price has broken out the level, then you can expect price to reverse off of the 161.8. Before it reverses off the 161.8, you may expect it to either break out of the 127 or like it did here, or also reverse off the 127 level. Okay, here is a GIF to show you guys what I mean. Okay, so we can see here price is currently at the 127.2% level. Okay, so if you watch closely, price did kind of test this level a bit before breaking out of it. And then once it breaks out of it, then we can expect a really nice bounce off of the 161.8 level. Okay. So let me know if you have any questions on the three Fibonacci methods so far. If you are a little bit confused, let me know as well. But we cover all of these in depth in our Fibonacci series. So not to worry if you are a little bit confused, if you've missed those. I think we will probably do those again sometime soon. So yeah, you can keep an eye out for that. Okay, let's move on. So next we're gonna be taking a look at Fibonacci projection. So we have Fibonacci projection actually uses the Fibonacci extension tool and not the Fibonacci retracement tool like the other tool um that like the other three methods that we've looked at previously. So this is because the Fibonacci projection uses 3 points that only the Fibonacci extension tool provides. So for Fibonacci projection, we use the 61.8, 70.6, and 100%. It's mainly those three, but you can also use the 127.2, 161.8, and the 200%. Okay. Pro tip, once again, for Fibonacci projection, we are also looking for a flash or zigzag kind of shape. So very often the projection and expansion tools, rather, the ones that both use the flash zigzag shape, those are typically used together to find a confluence area. Okay, now let's take a look at a couple of examples of this. Okay, so here's an example of a Fibonacci projection analysis. So we have a starting point here, middle point here, and ending point here. And you can see very clearly this flash shape. So this Fibonacci trend line, as I mentioned earlier, should follow price movement really closely. So follow the shape of the market, basically. Okay, so in this other example, we have the starting point, middle point, and ending point, and we are projecting this price to bounce off of a specific level. So we can see here we have identified this 78.6% Fibonacci extension. And this is extension we're looking at. As I mentioned, always look out for the zigzags. And you can see price really bounced off of this 78.6% Fibonacci extension. Okay, so here is the before, where we are using the projection, Fibonacci projection. So it's a little bit confusing because the method is Fibonacci projection, but we are using the Fibonacci extension tool that's on MT4 and TradingView. So as long as you remember that projection uses 3 points, I think you're good to go. So starting point, middle point, ending point, these are the 3 points that we're using. Remember this shape, this zigzag shape, and then the 78.6% Fibonacci projection that we are expecting. Then you can see price really bounced off of this 78.6% Fibonacci projection level. Okay. Next, let's take a look at another example. This is another kind of shape of the zigzag. It's inverted now. So we have a starting point, middle point, and ending point that follows the shape pretty closely. And then we are projecting price to hit the 100% Fibonacci projection. So we say that the 100% level is one of the most powerful levels because price is most likely to hit those levels. Okay, and you can see that's exactly what happened. Price reacted off of the 100% Fibonacci projection level, just as we expected. Okay. Okay. Now that we know how to identify some Fibonacci levels, let's take a look at how you know when is considered an invalid Fibonacci retracement. So when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So if they're assuming you are drawing Fibonacci retracement from the top to the bottom of the picture. So as I I showed you guys in one of the GIFs, price made a lower low from, or rather, we're drawing the Fibonacci retracement from the top to the bottom. So that's what we need. So an invalid Fibonacci retracement happens when price makes a lower low. So the lowest point or the ending point is no longer valid. So that's just basically what it means. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are negative. So the negative 27 and negative 61.8 that we use for Fibonacci expansion. And we'll touch on these as they basically go beyond your ending point and yet they are still valid. So we already talked about those in a couple of the slides before. So here's an example of an invalid retracement. So you can see the starting point here, ending point here, as I've highlighted. And because price has broken below my initial ending point, it then becomes invalid. Okay, as long as it breaks below the 0.0% level, it's invalid. Okay, so it's important to always remember to pick the lowest point with nothing to the right of your ending point. Okay, that kind of brings us to the end of our recap for the Fibonacci section. So let's get into the introduction for our Elliott wave theory now. Okay, let me know if there are any questions so far. Okay, seems like we are all good. So Elliott wave theory is a really popular approach to analyzing financial markets, particularly in trading. So it's based on the idea that price moves in repetitive patterns that's driven by investor psychology. So it's developed by Ralph Nelson Elliott in the 1930s. And the theory suggests that the market movements can be divided into a series of waves that follows a specific pattern. So these waves reflect the alternating dynamics of market optimism. So those would be bullish phases and market pessimism, which would be bearish phases. So it's basically a method of analyzing cycles in the market. And by analyzing these price movements, you can then forecast future market movements. Okay, now let's get into the different types of waves. So the first type of wave that I want to touch on is, so this is what a typical Elliott wave looks like. So it's pretty theoretical, so bear with me in this part. So firstly, we have the impulsive phase or impulsive waves, or we even call these motive waves. So many names for it, but it's basically the parts of the wave that are trending. So Elliott proposed that market trends consist of 5 waves in the direction of the primary trend, followed by 3 corrective waves. So these waves are known as impulse waves and are labeled with numbers 1, 2, 3, 4, and 5. So I have included in bullet points to show you guys, just to make it a bit clearer. So wave 1, this is the initial wave in the beginning of the trend. So it's often seen as the beginning of a new move after the previous correction. So this wave, wave 1 is typically not very strong yet. Next, let's take a look at wave 2. Okay, so after the initial rise of wave 1, there's typically a retracement or correction in wave 2. However, wave 2 doesn't usually retrace the entire movement of wave 1. Next, wave 3. So this is often considered to be the most powerful and the extended wave in the sequence. So it tends to be the strongest move in the direction of the trend and is typically longer and more dynamic than waves 1 and 5. Okay, so this impulsive phase, I forgot to mention, we're talking about the numbered phases here in the image that I've included. Okay, next, let's take a look at wave 4. So at the number 4, following the strong move of wave 3, there's another corrective wave in wave 4. Similar to wave 2, this wave retraces part of the movement of wave 3. So this is all leading us to the final wave 5. So this is the final wave of the trend and represents the last push in the direction of the primary trend. So it's often accompanied by reduced trading volume and can show signs of exhaustion. Okay, so next, let's take a look at the corrective phase and the corrective waves that are part of this corrective phase. So those are the next part that we're going to be talking about are the lettered ABC areas of the wave. Okay, you can take a look in this image as well. It's not so crucial to follow exactly the percentage. So once again, these use Fibonacci levels, which is why I thought it was important to recap on the Fibonacci techniques earlier. But all of these percentages are from Fibonacci, and it's important but not crucial points for you to follow exactly the percentage of the retracement. Anyway, let's get into the corrective waves. So after the 5 impulsive waves are complete, the Elliott wave theory suggests that there will be a 3-wave correction against the primary trend. So these corrective waves are labeled with the letters A, B, and C. So wave A, this is the first corrective wave after the completion of wave 5. So it's a counter trend move against the primary trend. So you can see here wave 5 is upwards. Wave A counters that upward movement. Okay, wave B, after the completion of wave A, there's a partial retracement in the opposite direction, as you can see here. So the partial movement is about 50% or 61.8% of wave A. However, wave B doesn't usually retrace the entire movement of wave A. So again, about 50% or 61.8%. Okay, next we have wave C. So this is the final corrective wave and is often the most dynamic of the 3. So it moves in the direction of the primary trend and can be quite strong. Okay, so once again, the percentages are not crucial to take note of, but it's important to maybe remember some of them. But what's more important is the 3 main rules that I'm going to be talking about in the next slide. Okay, so here are the 3 main rules, and these are really important rules that you should remember. So you can ignore this wave 1, 3, 5 thing here, but 3 main rules that you cannot ignore. Firstly, wave 2 cannot retrace more than 100% of wave 1. Okay, next main rule is wave 3 can never be the shortest of the 3 impulse waves. Okay, so you can see from the image I've included here, wave 3 has to be longer than wave 1 and 2. Next, we're looking at wave 4. Sorry, I misspoke. Main rule 2, wave 3 can never be shortest of the 3 impulse waves. So the 3 impulse waves that we're talking about is 1, 3, and 5. So 1 has to be the shortest. 3 can be longer than 5, but it should not be the shortest. Okay, next. Point 3, wave 4 can never overlap wave 1. So it has to be, just follow the dotted lines here, can never retrace more than the head of wave 1. Okay, the percentage over here, the 1, 3, and 5 is not super important for you to remember. These 3 main rules are more important. Okay, now let's take a look at some of the shapes. So here I've included some examples of entry and some shapes that you can take note of. Once again, there are, if I'm not wrong, more than 50 shapes for Elliott wave and harmonics. So it's a bit difficult for me to include all of the shapes, but I have tried my best to include a couple of important ones for you to take note of. Okay, so here examples of entry. We have the simple M shape and the W shape. Okay, this M and W patterns over here are a bit blurry, but it's basically the same thing. So you can ignore that. So simple M, let's take a look at this. The entry point is between these two heads of the M here. And the bottom, basically the corners of the shape M. So this is a simple M. When we're looking at an extended M, the extended M tends to be at the back of, or rather the second half of the shape. So it starts from the bigger half here to over here. So any point of this can be considered an entry point. Okay, next, let's take a look at the short-formed M. Short form, basically because the second half is shorter than the bigger half here. But for this shape, the entry point is solely at this tip of the M here. If we're looking at W, it's pretty similar here. Excuse me. The simple W will once again take into account all of the corners, and any of these 2 points can be considered an entry. Short-formed W, similar to the short-formed M, only the tip of the M can be, or the W can be considered an entry. Extended W, the highest point or the highest tip and the middle tip can be considered entries. Okay. So here's an example of a W bottom. So you don't really have to take into account all of these bars. Just really want to highlight the type or the shapes over here. So example of a W bottom here, we have, if you compare here, we're looking at a short form W, and this breakout here is our entry, goes in, and our target or profit target is over here. That's why we say that this point here is your entry, because it's the point of breakout. Okay, if we look at an example of M top, earlier we mentioned, if I go back, we're looking at the short form M, where entry is only here. Same thing, breakout is over here at the tip. So this is our entry, and we're going in for a sell towards our target profit over here. Okay. Okay, if you are a bit confused with the shapes, I've included some images of them labeling the tips of the W patterns and the W patterns over here. Okay. So next type of shape here, we are looking at a bullish Gartley and a bearish Gartley. So the rules, in this case, we are kind of going into harmonics over here. But there are a couple of rules for this pattern compared to the previous M and W patterns. So for a bullish Gartley, the AB leg, which is over here, the highlighted red leg, should retrace about 61.8% of the leg XA. So that's where your Fibonacci levels come in. Then the BC should retrace the 38.2% to about 88.6% of XA. So XA is the first line here. So we're looking at BC now. And then for CD, which is the last leg of this shape, CD is at least a 78.6% retracement of the original leg. So once you have all of those rules that are in line, then you can expect to enter over here, going for buy towards perhaps the A over here or the C. Similarly, if we're looking at the bearish, all of these levels still stand, but instead we're going for a sell instead. Okay. So just another shape for you to kind of take note of if you are interested in harmonics and Elliott wave patterns, because there are a lot of patterns out there. Okay, next we're taking note of a bat shape now. So the main rules of the bat pattern are the AB leg can retrace between 38.2% to 50% of the XA leg. So the AB leg is over here, the second leg here, retrace 38 to 50% of this original leg. BC can retrace 38.2 to 88.6% of this second leg. And the CD leg can retrace up to 88.6% of the original leg. CD leg can also be an extension between 161.8 and 2.618%. So because this is a tick or a Nike tick that we mentioned earlier, a Fibonacci extension, so you could also use the Fibonacci extension over here in this shape as well. And this is the shape that I was talking about, the inverted Nike tick. Yeah, the same thing, the same levels apply, same rules apply here as well. Okay, so it's bearish because we would then be going for a sell here. Bullish because we would then be going for a buy after point D. Okay. And then for our last shapes that I will go through for today, we have the butterfly shape and the crab shape. So let's start off with the butterfly shape first. So we have the 78.6%, the AB has to retrace of the XA. The BC has to retrace 38.2 to about 88.6 of the XA as well. CD has to retrace 161.8 to 261.8 of BC. So once again, this is a Nike tick as well, or the Fibonacci extension. Okay, or the CD can also retrace 127 to 161.8 of the XA. Okay, then you're going for a sell after D. Bullish, you're going for a buy after the D. Bearish, on the other hand, we have the AB retracing 38.2 to 61.8 of XA, and BC over here 38.2 to 88.6 of XA, and CD 224 to 361.8.5 of BC here. Okay, or 161.8 of XA. Okay, so yeah, these are all of the shapes that I will go through for today. Let me know if you guys have any other questions. Like I mentioned earlier, there are a lot of shapes out there. But yeah, I'm just gonna go through a couple in this webinar because this was quite information intensive, I think. I hope you guys are still with me. Okay, let me know if you guys have any other questions. If not, that brings us to the end of our webinar. Thank you guys so much for joining me today, and have a great rest of your week. And yeah, I'll see you guys next week. Bye, guys. Yeah, so these shapes are, let me go back. They are price action, yes. So it's kind of overlapping the price action and harmonics and Elliott wave theory as well. Okay, Jinuka, that's good to hear. Thanks, Stanley. Okay, see you guys next week. Thanks, everyone. Bye, guys. Take care.